You know what drives me absolutely insane? Watching smart people waste years arguing in endless YouTube comment wars about real estate versus stocks, picking sides like it's a religion, while completely ignoring the brutal real math, hidden tax superpowers, crushing costs, and the passive income trap that actually decides who gets rich and who just stays stressed and broke. Two guys, same $50,000 saved, same salary, same city. One becomes the proud landlord posting passive income on Instagram. The other quietly stacks index funds and gets ignored. 20 years later, one has real freedom and massive net worth. The other is wealthy on paper but exhausted from tenants, toilets, 3 a.m. calls, and surprise $10,000 repairs. If you choose wrong, you'll burn decades, lose tens or hundreds of thousands to hidden fees and taxes, and take unnecessary risks. But today I'm exposing the complete honest math, including 2026 real estate tax benefits that can slash your bill by thousands annually, and why REITs might be the true passive income king most rental gurus hate. Stay until the very end because the shocking year 15 tax twist, the REIT leverage myth destroyer, and the one factor nobody calculates, your time, will flip everything you thought you knew. Smash subscribe, like if you're done with shiny thumbnails, and let's run the brutal truth right now. Hey everyone, this is Liba Finance. Today we're settling real estate versus stocks, the real math once and for all. We're tracking Jake the landlord and Marcus the index fund investor over 20+ years with identical starts. No cherry-picked numbers. We include mortgage payments, cash flow, appreciation, compounding, maintenance, vacancies, taxes, leverage, your precious time, market crashes, inflation, and psychological reality. Jake and Marcus are both 30, same $55,000 salary, same $50,000 saved. Jake uses his $50,000 as 20% down on a $250,000 rental property. Marcus invests the full $50,000 in a total stock market index fund and adds $300 every month automatically. Right from day one, the psychological difference hits hard. Jake drives by his property feeling proud like a boss. Marcus just sees another boring brokerage notification. That feeling gap influences every single decision for the next 2 decades, and feelings are expensive. In the first 3 years, Jake collects rent, claims big tax deductions, and builds equity fast with leverage. It feels amazing, but real costs start eating the easy cash flow: property taxes, insurance, a broken water heater, a roof leak, and that first vacancy month. His advertised $470 monthly cash flow shrinks to almost nothing after real expenses. Marcus just watches his portfolio grow steadily with historical market returns. No drama, no phone calls, no surprise repairs. The early years fool a lot of people into thinking real estate is the clear winner. By years 4 to 7, reality really bites for Jake. He faces a major roof replacement, plumbing emergencies, a bad tenant who stops paying and damages the place, plus all the time spent managing it like a part-time unpaid job. His cash-on-cash return drops to a disappointing 3 to 5%. He's working harder for less real profit than he expected. Meanwhile, Marcus hits the acceleration phase where compounding really kicks in. His money starts making serious money. When we compare net worth, time invested, and stress levels at year 7, the gap is already widening in surprising ways. Now let's talk about the real estate tax benefits that can completely change the game in 2026. This is where direct rental properties shine and often crush stocks in taxable accounts. Thanks to current tax rules including 100% bonus depreciation and enhanced provisions, rental properties remain one of the most powerful tax-advantaged assets available. You can deduct the cost of the building over 27.5 years through depreciation, creating paper losses that offset your rental income and even reduce taxes on your regular salary. On a $250,000 property, that can mean $8,000 or more in annual deductions. Add cost segregation studies and you accelerate massive write-offs upfront on improvements, appliances, and fixtures. Mortgage interest is deductible on investment loans, especially powerful in the early years. The qualified business income deduction gives up to 20% off rental income. Property taxes, insurance, repairs, and management fees are all deductible. And with 1031 exchanges, you can defer capital gains taxes indefinitely by rolling into bigger properties. These benefits can slash Jake's effective tax rate by 30 to 50% or more compared to Marcus paying full taxes on dividends and capital gains in a taxable brokerage. For high-income earners in high-tax states, this can save $15,000 to $40,000 per year. But here's the twist. You only get these benefits if you actually survive the operational headaches and manage the property correctly. Many people lose the tax advantage because bad cash flow forces them to sell too early. Years 8 to 12 bring the real battle between leverage and compounding. Jake sees property appreciation and mortgage paydown building serious equity. But ongoing capex, vacancies, and opportunity cost keep mounting. We modeled different appreciation rates, repair cycles, and economic conditions. Marcus's portfolio continues exploding through consistent contributions and compounding. When we run the full numbers including taxes, the diversification across thousands of companies gives him protection that one single rental property simply cannot match. Remember 2008 and 2020, diversified investors who followed the right order stayed calm and bought the dip while many landlords panicked. Now let's talk about REITs for true passive income. The option most active landlords fear because it exposes how much work their passive rentals actually require. REITs let you own pieces of large-scale real estate through the stock market without ever dealing with tenants or toilets. They must distribute 90% of their income as dividends, often yielding 3 to 7% or more. You get instant diversification across hundreds of properties in different sectors like apartments, offices, warehouses, data centers, and healthcare. Total liquidity, sell anytime. Low entry barriers so you can start with a few $100s instead of a $50,000 down payment. In 2026, sectors like industrial and healthcare REITs are positioned strongly. Compared to direct rentals, REITs deliver similar or better total returns with zero management time. Number 3 AM calls, no evictions, no maintenance surprises. The math shows that over 20 years a REIT portfolio often outperforms a single rental after accounting for all the hidden costs and time. But direct real estate still has the edge on tax leverage through depreciation and 1031 exchanges that REITs don't offer in the same way. The smart move? Hold REITs inside tax-advantaged accounts like Roth IRAs or HSAs to minimize the ordinary income tax on dividends. Many burned-out landlords switch to REITs and report finally feeling truly free while still collecting real estate income. In years 13 to 20, the long game reveals the full picture. Jake's property has appreciated, the mortgage is lower, and cash flow improves if he survived the middle years. But after valuing his time at a realistic hourly rate, the net freedom and returns tell a different story. Marcus's portfolio, fed by consistent contributions and compounding, often ends significantly ahead in liquid net worth with far less stress and total flexibility. Concentration risk is massive in direct real estate. One property in one location means one bad event can hurt you badly. Stocks and REITs spread risk across thousands of assets. Inflation hedging works for both, but after real expenses, real estate doesn't always win. Audience fit matters most. Young, aggressive investors with time might love direct rentals. Busy professionals with families usually win bigger with REITs and index funds. Psychology plays a huge invisible role. The pride of ownership feels great until the stress piles up. Many people report higher life satisfaction after switching to passive REIT strategies. Hybrid approaches deliver the best of both: core wealth in low-cost index funds and REITs for passivity and diversification, then satellite direct rentals using tax benefits and leverage for extra boost. Here's exactly how to combine them. First, follow the optimal order. Destroy high-interest debt, build your emergency fund, capture every employer match, max out tax-advantaged accounts like Roth IRA and HSA. Then layer your growth. Heavy index funds and REITs for the majority of your portfolio, and 1 or 2 carefully chosen rentals for tax advantages and leverage. Use house hacking to start, automate management, and refinance strategically. This blended approach often delivers strong double-digit returns with lower overall risk and much better life quality. Risks include interest rate changes, liquidity problems with physical property, legal tenant issues, and black swan events. Stocks bring volatility but faster historical recovery. Protect everything with proper insurance, LLCs, and estate planning. After all the math, tax superpowers, REIT secrets, risks, psychology, and hybrid strategies, the nuanced winner depends on you. For most busy people who value time freedom and low stress, REITs combined with broad index funds win because they deliver real estate-like returns without the headaches. Direct rentals can outperform if you have the right personality, systems, and tolerance for work. The real secret is stopping the all-or-nothing debate and building a personalized hybrid portfolio. Here is your exact actionable checklist. 1. Assess your current net worth, cash flow, risk tolerance, and time availability. 2. Destroy high-interest debt and build a 3 to 6 month emergency fund first. 3. Max your employer match and tax-advantaged accounts. 4. Run your personal numbers with calculators to compare scenarios for your age and situation. 5. Start small. Invest in a REIT ETF and analyze one potential rental property. 6. Scale monthly contributions to index funds and REITs. 7. Add direct real estate only when ready with strong systems. 8. Review quarterly, rebalance, and adjust as life changes. Imagine waking up to growing passive income, diversified growth, and real freedom. That future starts with your next paycheck. If this video gave you clarity, like it, comment below with your biggest takeaway and whether you're leaning toward REITs, direct real estate, or a hybrid after today. Subscribe and turn on notifications for more deep math videos. Share this with someone stuck in the debate. This is Liba Finance. Let's build real wealth the smart way. I'll see you in the next one.